Over the past few years, I've been investing in a portfolio of dividend growth stocks. The goal is to build a compounding source of passive income while earning a high total return. Every month, I share an update of my portfolio here on YouTube, explaining all my changes. However, I don't often get to provide updated thoughts on each of my holdings. So today, I'm going to rank each stock in my dividend portfolio based on the current quality of their business. This tier ranking will be determined based on various factors like their current financial strength, balance sheet, growth potential, and economic moat. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoy the video. Throughout, I'll be using my personal stock research tool available at dividenddata.com. Here you can analyze stock financials for over 8,000 US stocks. I designed the tool so you can see every notable financial metric displayed with detailed charts and tables as well as calculated growth rates. Become a member of dividenddata.com so you can research stocks just like me. Currently, my dividend portfolio sits at 13 total stocks. I will be ranking these in a tier list shown here. S tier is the highest ranking, followed by the A tier, B tier, C tier, and finally the D tier. I'll go from left to right with the images on the bottom here. First, we have Apple, ticker symbol AAPL. This is my fifth largest position by total value, representing 7.3% of the portfolio. Based on Apple's business in 2023, I'm going to put them in the S tier. Apple is the most valuable company in the world with a current market cap of $2.7 trillion. That status is justified. In fact, Apple is such a great business, it's often overlooked by investors. It's too obvious. Since the launch of the iPhone, Apple's earnings have grown dramatically, followed by a similar rise in stock price. In the US, the iPhone's market share sits at over 57% and is somehow still slowly growing in recent years. This is the core cash cow of the company, followed by their other hardware products like the Mac, iPad, wearables, etc. Nearly all of these products are giant successes in their own right, but the iPhone is still king. Future growth will come from expanding the market share and creating new products. For example, the Apple VR headset and long-rumored Apple Car. Aside from new product sales, Apple is growing a giant high-margin services business. This includes App Store fees and subscription services like Apple Music, Arcade, Fitness Plus, News Plus, and TV Plus. They also have advertising, Apple Care, cloud services, and payment services. In fiscal 2022, the services business generated $78 billion in revenue with $22 billion of costs, giving it a high 70% gross margin. This is compared to Apple's hardware products, which hold a strong 36% gross margin. The services side of Apple continues to grow at a high rate. This balances out the iPhone-heavy hardware sales, which will see slower growth into the future due to the company's massive existing market penetration. That said, the value in having this existing group of loyal users is immense. The iPhone is the focal point of people's lives. It is perhaps the most valuable item you could buy for its relative price. Apple can leverage their large user base to expand their services and monetize that connection further. That will be a key part of Apple's future growth. 2023 is proving to be a slight financial decline for the company, but the key metrics still look great long term. In the latest quarter, Apple reported all-time record services revenue and the highest total number of active devices ever. The company increased their dividend payment by 4.35%. This makes the 11th consecutive year of dividend increases. On top of this, Apple's board approved an additional $90 billion for share repurchases. Share buybacks mark an important part of Apple's total return. This increases your relative ownership stake in the company. Over the past decade, decade, Apple's shares outstanding have declined by over 40%. That is a massive difference. As a shareholder, the financial metrics of Apple are very strong. Over the past 10 years, the revenue per share has grown at a 15% compound annual growth rate. In that same time, free cash flow per share has also grown at a 15% CAGR. This growth rate has accelerated in recent years. Apple's growing free cash flow is what fuels their share buybacks and dividends. The Apple dividend has grown for 11 consecutive years with a 10-year CAGR of 8.22%. Dividend growth has slowed in recent years as the board has showed a preference towards shared buybacks. However, the financial strength of the company has continued to grow. Apple's dividend payout ratio now sits at under 15%. This gives Apple significant flexibility to invest in their business or continue rewarding shareholders via dividends or buybacks. Apple's financials are stellar. The only negative trend I've been watching is that the cash on hand has continued to decline for the past few years, now sitting at $55 billion. This is as the company has been very aggressive with plowing cash into share buybacks. That said, Apple has incredible financial strength, so there is no major risk here. Overall, Apple's business is incredible. They have an economic moat with their large product ecosystem and seamless connection via their products. It truly deserves to be the most valuable company in the world and be in the S tier on my list. Stock number 2 in this ranking is Broadcom, ticker symbol AVGO. I added to my Broadcom position in early 2023 and view it as one of my top dividend growth stocks. To date, I have a 19% total return and will continue buying more on dips. It is currently my 7th largest stock by total value. So where do I rank the stock? I'm going to rank Broadcom in the A tier. Broadcom is a financial beast. The strong earnings growth has led to large stock price appreciation and dividend growth. Revenue per share has grown at a 23.71% 10-year compound annual growth rate. Free cash flow per share is growing at a 35.95% 10-year CAGR and 19.56% 3-year CAGR. This high growth has allowed Broadcom to grow their dividends to shareholders at a reliably high rate. As a chip designer, Broadcom is fabless and relies on third-party manufacturers to create their semiconductors. This is vital to understand. That means Broadcom does not need to invest in creating high-end manufacturing, which is highly capital intensive. Instead, they can use profits to invest in growing the business and rewarding shareholders. The 5-year CAGR of the dividend is a massive 21.32%. This has slowed in recent years but remains high. Most recently, they had a 12.2% dividend increase. Financially, Broadcom is very impressive and deserves a high ranking in my portfolio. If you want to see a deep dive into the company's business model, I would check out my full stock review video I made a few months back. I really think this has some great value. Despite the strong financials, I do not put Broadcom in the S tier. The reason is that their economic moat is not as strong as companies like Apple. Broadcom semiconductors face risk of competition among big tech giants looking to vertically integrate. One example of this is the iPhone, which has started designing more and more of its chips. It's been announced that some of Broadcom's iPhone chips will be phased out in upcoming phones. This is only a small percentage of their business, but it's a notable trend and real risk. Additionally, there is the risk that Broadcom, like many fabless chip designers, rely on manufacturing partners like TSMC. There are possible geopolitical tensions there with China. Finally, the bulk of Broadcom's massive growth comes from mergers and acquisitions. As the company keeps getting bigger, there is risk that regulation could block many of these deals. That was seen with the proposed Qualcomm merger. Luckily, the company is pivoting to software with the VMware acquisition, hoping it will see less regulatory scrutiny and diversify the company. Broadcom is an absolute powerhouse and deserves its A ranking. Stock number 3 in my ranking is Chevron, ticker symbol CVX. This is one of the American oil giants, being a direct descendant of Standard Oil. I invest in my oil stocks during 2020, with Chevron being my second lowest position by current value, with a large 86% total return. In 2023, I'm going to put Chevron in the B tier. The company is in a very strong place financially thanks to the recovery in the price of oil and a record 2022. In this time, Chevron and all other big oil companies have been money printing machines. This has allowed them to pay off debt and build their balance sheet as they prepare for future down cycles. Chevron now has $15.7 billion in cash on hand and has reduced their debt by over $20 billion. These all-time all-time high free cash flows give Chevron and others financial strength to face the future. On top of this, Chevron continues to grow their reliable dividend payment. Over the past 5 years, the Chevron dividend has grown at a 6.16% compound annual growth rate. The most recent increase was 6.34%. Despite reliable dividends, the core risk in the oil and gas business is the cyclical nature of the commodity price. This leads to large boom and bust cycles. At times of low oil prices, Chevron's profits will shrink or even go negative. However, they store cash in the boom times to continue rewarding shareholders and investing in the business. Long term, the business faces risks of disruption from renewable energy sources. However, overall energy demand is only projected to increase over time. Oil and gas will play a large role in this future. Companies like Chevron will invest so they can adapt to this changing energy economy. I put Chevron in the B tier. Stock number 4 in my tier list ranking is Disney, ticker symbol DIS. This is the biggest loser in my portfolio with a negative 38% return. Despite being in my dividend stock portfolio, Disney has had their dividend suspended since 2020. The pandemic forced the closure of their theme parks, which is their main profit driver, along with closing movie theaters and slowing their production times. This was a massive disruption. At the same time, the company was investing heavily in their direct-to-consumer streaming services. This required large content spend, making them unprofitable. In 2023, these conditions are starting to improve. The parks are highly profitable, reaching all-time highs and growing. Streaming losses have peaked in 2022 and are starting to narrow. However, linear television is in secular decline, made worse by a poor advertising market in the current recession. I'm going to put Disney in the D tier. That said, I think it has the potential to climb over the coming years to C, B, and even A. In my opinion, it's obvious Disney is only going up from here. Since Bob Iger returned as CEO, they are shifting focus towards profitability. No longer will they attempt to grow streaming subscribers at any cost. They are raising prices and cutting costs. It's working, as core Disney Plus subs saw no decline after a major price hike. This is a good sign moving forward as they strive to make Disney Plus profitable in fiscal 2024. Profitable streaming is the key metric here. Once achieved, Disney will move far up this tier list. Disney's earnings per share are still half of that pre-pandemic, even though revenues are growing to all-time highs. My prediction is that by the end of Iger's 2-year CEO term, Disney's earnings will match their prior highs with sustainable growth moving forward. Disney's board has announced the plan to declare a dividend at the end of fiscal 2023. The major risks here are the decline of linear television. If this decline exceeds the profitability of streaming, then Disney will be in trouble. However, I continue to believe that there will be a period of overlap where both can be profitable. Overall, I still view Disney as the best media company in the world. They own iconic franchises with the best monetization methods across theatrical releases, consumer products, and theme parks. The scale of this operation is unrivaled. Regardless, the current economic reality and disruption in the media sector forces me to rank Disney as a D. Stock number 5 is Enterprise Product Partners, ticker symbol EPD. This is a midstream energy company operating oil and natural gas pipelines. EPD is my second lowest stock by current value, but is my 5th largest dividend payer. These dividends and capital appreciation have generated a strong 61% total return. I'm going to rank EPD as a C on the tier list. EPD is a reliable cash-generating business that pays large dividends. As a pipeline business, they profit from the transportation of energy. This makes them less directly impacted by commodity price fluctuations. EPD has a long history of dividend growth with a 10-year CAGR of 3.88%. This growth has accelerated in the past 2 years with 2 increases per year. Management has stated they strive to return 75% of cash generated to shareholders via dividend. With its low valuation and high dividend yield, this makes EPD a strong consideration for dividend-focused investors. However, its tax status as an MLP means you won't get the benefits of long-term qualified dividends. EPD could very well be in the B tier, but I have it in the C due to its lower ceiling. To accelerate growth, the company would need to invest in new pipelines, which can be expensive. Also, that growth would likely require debt based on their history and current low cash position. That said, EPD provides a vital service, and I project slow, reliable growth into the future. Stock number 6 is Kroger, ticker symbol KR. Kroger is one of the leading grocery chains in the United States. On top of this, they own a group of other independently operated grocery chains across the country. Kroger is the 9th largest stock in my portfolio, and I currently have a 44% total return. I'm going to rank Kroger in the C tier. Kroger has seen reliable earnings growth over the past decade. Revenue per share has grown at a 7.42% 10-year CAGR. Free cash flow per share has seen similar growth. 2023 was a weaker year for free cash flow relative to a very strong 2021 and 2022. Personally, I am monitoring this trend, and it is lowering my current ranking of the company. That said, Kroger has a great track record of returning cash to shareholders. They have been buying back shares at a high rate for decades. Additionally, they have a high-growing, sustainable dividend. The 10-year CAGR of the dividend is 13.24%. The most recent increase was a massive 23.81%. Based on recent cash flows, though, I'd expect this growth to slow. The current payout ratio is still very low at 30%. This will allow room for future dividend growth and Kroger to invest in their business. Speaking of investing, Kroger is currently in the process of merging with Albertsons. This is another grocery conglomerate similar to Kroger, which would make them the largest grocer in the United States. However, there is uncertainty about whether this deal could be blocked by regulators. Regardless, Kroger is in a strong position in grocery. They have a large network of private label products which allow them to offer cheap prices and increase their margins. That said, I do think Kroger has a fundamentally weaker business model compared to the membership wholesale clubs like Costco. The subscription membership fees add another level. This makes me put Kroger in the C tier. However, if their cash flows improve back to prior levels, they could rise to the B tier. Stock number 7 is the Altria Group, ticker symbol MO. Altria is the leading tobacco company in the United States with top brands like Marlboro. Despite declining smoking rates, the company has continued to grow earnings and dividends. They have a dominant position in their market and a wide economic moat. The obvious risks here are regulation. In my ranking, I have Altria in the B tier. Altria is the 3rd largest stock in my dividend portfolio with a 13% total return. It is my largest dividend payer by far thanks to its high yield. Free cash flow per share has grown at an 8% 10-year CAGR, now exceeding the level prior to the Philip Morris International spinout. Dividends have grown at a 7.8% 10-year CAGR. The most recent increase was 4.44%. This growth is sustainable thanks to Altria's rock-solid free cash flow. I recently made a full video breaking down Altria's stock, which I'll link here. Stock number 8 is Microsoft, ticker symbol MSFT. This is my largest position by total value, making up 26.5% of my portfolio. The bulk of this position was added in fall 2022, and my current total return is over 32%, making up 26.7% of my portfolio. I view Microsoft as one of my core long-term holdings and rank the stock in the S tier. The company has seen massive earnings growth over the past decade, leading to significant stock price growth. This growth will likely continue long-term thanks to the company's dominant positions in key markets like cloud and enterprise software. These are secular trends that will continue. Microsoft may have even found a new growth driver with artificial intelligence and their partnership with OpenAI. At a minimum, AI will accelerate their existing businesses by increasing cloud demand and improving Microsoft's suite of software. The economics at Microsoft are stellar. Over the past 5 years, revenue per share is growing at a 17.9% compound annual growth rate. Free cash flow per share is growing at a 16.5% 5-year CAGR. This reliable and growing free cash flow makes Microsoft a cash cow. The money just keeps stacking, now at over $104 billion in cash on hand. They buy back shares and pay growing dividends. The Microsoft dividend is growing at a 10% 5-year CAGR. This is very sustainable with a payout ratio of 25%. Aside from rewarding shareholders, Microsoft uses cash to invest in their business and make acquisitions. Despite a weak 2023 tech sector and general macroeconomic weakness, Microsoft is still projecting slow growth for the year. The financial strength is unquestioned, and Microsoft clearly deserves to be ranked in the S tier. If you want to learn more about the company, I made a full stock review linked here. Stock number 9 is PepsiCo, ticker symbol PEP. This is one of the world's most dominant food companies, diversified across both snack and beverage. They own top brands in many categories. PepsiCo is a rock-solid business. However, organic growth will be on the slower side due to their existing large market penetration. I rank PepsiCo in the B tier. This is my 11th stock by current value with a 52% total return. Earnings growth has been great in recent years, but a large amount of that can be attributed to inflation. The company has pricing power in its brands, demonstrating the ability to pass rising costs onto consumers. They are one of the best examples of inflation-resistant companies. It's very impressive. This has led to accelerated growth of financials and the dividend payment. PepsiCo just increased its dividend by 10%. That is massive for an established, reliable grower like PepsiCo. That said, the current valuation is very high. It's priced at a premium, and it seems obvious to me that most inflation-related price increases have already occurred. Stock number 10 is T. Rowe Price, ticker symbol TROW. This investment management company is known for their vast array of mutual funds and other investment products. TROW is my 6th stock by current value and 3rd largest dividend payer. My current total return sits at -2%. I'm going to rank TROW in the B tier. Financially, the company is very strong. It has $2 billion in cash on hand with only $300 million in total debt. On top of this, they run a very low-cost operation. Virtually all their profits come from fees on assets under management. This is a highly scalable business model. As long as assets are growing, so will their revenues. However, this does make them vulnerable to asset price fluctuations. We are seeing that right now. With the stock market decline in 2022 and our current recession, TROW earnings have seen a large decline. This has been matched by the 50% drop in stock price, which is rational. However, I used this as an opportunity to buy my current stake in the company. Over the past 10 years, revenue per share has grown at a 9% CAGR. Free cash flow has seen similar growth. Since the business is very efficient, T. Rowe Price returns the bulk of these cash flows to shareholders via buybacks and dividends. Over the past 10 years, the T. Rowe Price dividend has grown at a 12.37% CAGR. They even pay large special dividends such as this 2021 $3 per share special dividend. With the recent decline in earnings, T. Rowe's latest dividend increase was only 1.67%. This is very understandable. In my opinion, T. Rowe remains a great dividend growth stock with an attractive valuation at current prices. However, there are risks. For example, mutual funds have been losing market share in the investment community compared to ETFs. Since that is a large part of T. Rowe's business, it is a concern. That is why I put them in the B tier rather than the A tier. Stock number 11 is Texas Instruments, ticker symbol TXN. This is my 8th stock by current value with a 9% total return. I'm ranking this semiconductor stock in the A tier. Texas Instruments is a leader in analog semiconductors, vertically integrated with their own manufacturing. That can be a negative in terms of capital investment, but Texas Instruments faces less competition, and much of their chips are not at the technological cutting edge. This means they don't have to spend as much on fabrication plants compared to companies like TSMC and Intel. Instead, Texas Instruments runs with a focus on generating cash flow and rewarding shareholders. Over the past 10 years, free cash flow per share has grown at a 9% CAGR. This has led to consistent share repurchases and dividend growth. The 10-year CAGR of the dividend is a massive 19.43%. This has slowed down and is skewed from a few years of massive growth. The most recent increase was 7.83%. I'd expect growth to be in this lower range for the next few years. In fiscal 2023, it seems like Texas Instruments will be having a weaker year based on their Q1. It's for this reason I'm being hesitant and waiting for a larger dip before buying more. The company is financially strong and could handle any short-term decline. It has $9 billion in cash on hand and neutral net debt. Over the long term, Texas Instruments has a dominant position in a sector with secular growth. This is why I put them in the A tier, but it should be noted, head-to-head versus Broadcom, I would put them below Broadcom. So really it's more of like an A- or B+. Stock number 12 is Visa, ticker symbol V. This stock is 10th in my dividend portfolio by current value. Despite it being one of my smaller positions, I'm going to rank Visa in the S tier. Visa is the leading global digital payment network with over 60% credit card market share in the United States. Visa operates the network through which transactions are processed, and they bear no direct credit risk. That risk is all on the financial institutions that use Visa's network. Visa simply provides the software and collects transaction fees. This gives them a highly scalable business model that will benefit massively from the global shift to digital payments. Visa's earnings are growing and blowing past their all-time highs. Free cash flow per share is growing at a 19% 10-year CAGR. Visa uses this cash flow to reward shareholders with buybacks and dividend growth. Visa's dividend is growing at an 18.49% 10-year CAGR. Their most recent increase was a massive 20%. This is very sustainable with a 20% payout ratio. Visa is a money printing machine with 80% gross margins and 50% net margins. As the payment volume scales, profits will continue to soar with little incremental cost. Currently, Visa has $16.5 billion in cash on hand and $4 billion in net debt. The company is a financial juggernaut with a rock-solid business model. It is truly deserving of its place in the S tier. The major risk here is regulation, which has already stopped some of Visa's acquisition plans. This is because regulators view Visa and MasterCard as a duopoly, which is the reality kind of. However, it is those exact monopoly-like economics that place them in the S tier. Finally, stock number 13 is ExxonMobil, ticker symbol XOM. This is my second largest stock by total value, but only because of the massive gains. I have a 199% total return. I bought this position during the 2020 oil crash when prices were unprofitable. Overall, I'd rank Exxon in the B tier. Much of this reasoning is similar to my Chevron analysis from earlier in the video. The oil and gas business is highly cyclical, with profitability levels depending on the commodity price of oil. Right now, Exxon has been in the boom time. They have been raking in profits. Exxon now has $32.6 billion in cash on hand and has lowered net debt to $8 billion. This puts them in a position of financial strength into the future that will allow them to invest in future businesses like carbon capture and renewable energy. Additionally, it has secured their dividend payment far into the future as the balance sheet is fortified for the next down cycle. I'd expect slow, reliable growth moving forward. They just had a 3.41% increase this past year. In addition to dividends, Exxon's board is using record profits to approve large share buybacks. I'm planning to hold my Exxon position and will likely not add more till the next large down cycle. I hope you enjoyed this ranking of all my dividend stocks. Remember, this analysis is just my personal opinion, so make sure to follow your own judgment before making any investment decisions. You can sign up for dividenddata.com to track your portfolio and research stocks just like me. Leave a like and subscribe to the channel if you enjoyed the video. Thanks for watching.